Welcome from Trend Signal for our review of the data and events the week beginning the 6th of April. And we're already into the week. It's now the 7th following the Easter break. Last week markets fairly subdued. Equities were mixed with the FTSE, S&P, Dow, DAX, all slightly positive territory, although the DAX was probably the best performer, up about 110 points. The dollar took quite a slip fall from the published non-farm payroll, the employment data last Friday. Sterling was sort of not really the one to watch. It was fairly subdued, up slightly against the dollar. Gold also reacted positively to the slip in the dollar, up $4 or $5 on the week. And crude oil continues to get tugged around by macro events. The outline agreement with Iran on the nuclear program, which could lead to a lifting of sanctions on oil, amongst others, helped push crude down about $1 last week. But last week really was dominated by the non-farm payroll data, or NFP for short, that was reported last Friday when the US market was shut, and obviously all the European markets were as well, in observance of the Easter holiday. Payrolls increased by a very modest 126,000, which was a lot lower than expected. In fact, the smallest gain since December 2013. But not only that, they also revised the previous data by 69,000 jobs less. So overall, the impact was fairly negative. And I think really what's happening now is that the actual jobs market supports other data, which has been showing slower economic growth from Q1. Strong US dollar, weak oil prices, and extreme weather were the main reasons cited as for a drag on the economy. In terms of reaction, the equity and bond markets were shut, so we really had to wait until Monday to see the reaction in the US, and on Tuesday to see the reaction in Europe. US dollar fell, not surprisingly. Equities and bonds rallied. A little bit surprising to see equities rally quite the way they did, but certainly that was in reaction to the poor non-farm payroll data. Bonds subsequently have slipped back as traders mull the effect on interest rate projections. Fed watchers, economists who love to see what the Federal Reserve are doing, have pushed back the date for the first rate rise, which was initially penciled in for June this year. They've now pushed that back to September, really at the earliest. And bulls argue that employment will pick up again in Q2 as weather is no longer an issue and firms adjust to the stronger dollar. I say bulls, that's bulls in the stock market, although bond markets are taking a more realistic view, in my opinion. Time will tell. So in terms of the analysis, really, despite the weak payroll data last Friday, the US economy, I would assume, is expected to recover in the second quarter. Bond markets gave up most of the ground, as I said, as traders expect the jobs data to improve, which one would expect. The bad weather that was experienced in Q1 certainly has not been repeated. It is unlikely to be repeated. Knee-jerk reaction in the US dollar. We saw euro dollar hit 110.25, 110.25, but the dollar has recovered most of these losses as the euro is now trading back below the 109 level. The Aussie dollar, we've already had some news regarding the Aussie dollar. The Royal Reserve Bank of Australia surprised the markets by not cutting interest rates. Expectations were that the Reserve Bank of Australia would cut rates in response to plunging oil prices, iron ore prices, I beg your pardon, which we discussed last week, which is a real big drag on the mining sector. But I think concern over the Aussie dollar weakness was cited as a reason, although got to remember that interest rates in Australia still remain at their lowest level since the 1960s. So data and events this week, which is our focus just in planning for the week. We're already on Tuesday. It's a very light calendar this week following the Easter break. I think the focus is on the FOMC and to a lesser extent the Monetary Policy Committee here in the UK. The FOMC, the Federal Open Market Committee, they are reporting their minutes from the previous meeting. And as we recall what happened in the previous meeting, Janet Yellen effectively said there was going to be a rate rise this year, but she implied that it wouldn't be in June, and that's what gave the markets a little bit of encouragement. And we wait to see exactly what was said in that meeting. So the minutes on Wednesday at 7 o'clock in the evening, although markets certainly in Europe will obviously be shut, but it'll be fascinating to read exactly what was discussed in those meetings. MPC minutes the following day on Thursday, not a lot really to look for there. We don't expect any surprises. We are now in the run-up to the general election here in the UK, which happens on May the 7th. So the central bank will keep fairly stum without affecting the markets in any way, I would expect. In light of the weak non-farm payroll data last Friday, the weekly unemployment statistics in the US will actually sort of be added interest for traders just to see exactly where the unemployment claims are going to be going. The unemployment rate still remained good in the US last Friday at 5.5%, but it was the tail off in the number of new jobs. And I think by looking at the unemployment claims, we'll get a better idea as to whether the economy is going to rebound in the second quarter, which most economists believe is going to happen. Anyway, that's it. So a fairly light calendar this week. Certainly markets seem to be recovering some of the ground that was lost or gained, depending on which market you're looking at, following the non-farm payroll. But let's see how that progresses this week. Thanks very much for listening. Bye for now.
If you would like more information about trading the right way, Trend Signal is giving you the opportunity to see and hear about its services live at a free online seminar. Take a look at the Trend Signal website for the latest events and to book your free place.